Welcome to The Deep Dive, your weekly shortcut to being truly well-informed. We take the most complex earnings calls and filings and, well, we distill them into what you really need to know. Today, we're jumping into the Q3 2025 results for Heritage Global. That's ticker HGBL.
Right, and for anyone who's not familiar, they operate in a really interesting space, sort of at the crossroads of distressed finance and industrial surplus.
Exactly. They help companies sell off assets they don't want anymore. So the stage was set November 6th. They dropped their numbers after hours, had the conference call, and the market reaction was, let's just say it was immediate and not good.
Not good is putting it mildly.
So our mission today is to figure out why. Why did the numbers miss so badly? What's going on with their margins? And maybe most importantly, how management is trying to pivot this whole story away from the bad quarter and towards a future built on M&A.
Okay, so let's start with the headline figures, because that's where the disconnect is just so obvious. The street was clearly not ready for what they reported.
Not at all.
The big number, the diluted GAAP EPS, came in at just 2 cents.
2 cents. And the consensus was 4.
A full 50% miss. But here's the kicker. It wasn't just a miss against what analysts were hoping for. It was actually down from the 3 cents they did in the same quarter last year.
So the trend is literally going in the wrong direction.
Precisely. And the top line, the revenue, it didn't really offer any good news to cover up that profit miss.
It never does it?
Well, revenue came in at $11.36 million. The consensus was looking for something closer to $13.07 million. So that's a pretty chunky 13% miss.
Okay, but I did see they tried to spin the year-over-year growth number.
They did. And technically, they're not wrong. They delivered 9.1% revenue growth compared to last year. But that's the whole story right there. They push more sales through the system.
But they couldn't turn it into profit. It's that classic working harder for less problem.
You've got it. And that's what we need to drill down on, because the profit numbers tell a much uglier story. Net income just got crushed.
How bad was it?
It dropped about 46% year over year. It came in around $585,000 when it was over $1 million this time last year. A huge hit.
Wow. And I'm guessing the other profitability metrics weren't any better?
Nope. Consolidated operating income, that fell about 12%. And if you look at adjusted EBITDA, which is supposed to give you a cleaner look at the core business,
It also went down.
also slipped down to $1.6 million from $1.9 million last year. There's just, no way to hide that kind of margin compression.
Okay, but to be fair, management did point to a sort of accounting hiccup, a non-cash thing that made the GAAP number look worse. We should probably explain that.
Yeah, that's important context. A big chunk of that net income hit was a non-cash adjustment. It's related to their deferred tax assets, specifically their NOL carryforwards.
So old losses they can use to offset future taxes.
Exactly. And they basically had to get more conservative about when they think they'll be able to use those tax breaks. So it hits the GAAP number now, but it's not cash walking out the door. It explains some of the miss, but it definitely doesn't excuse the underlying squeeze on the business.
Right, so let's talk about that squeeze.
Yeah.
Why was it so soft operationally? It looked like the type of revenue they brought in was a huge red flag.
Oh, it was maybe the biggest red flag of all. The market hates this kind of shift. You see, their services revenue, that's the sticky, recurring, fee-based stuff.
The stuff you get a high multiple for.
Right. That actually decreased. It went from $8.1 million down to $7.5 million. Meanwhile, asset sales revenue, which is all one-off transactional auction money,
The unpredictable stuff.
that jumped a lot, from $2.3 million to $3.9 million. So you've got this top line number that's going up, but it's being driven entirely by lower quality, less predictable income. That's a direct derating event for the stock.
Makes perfect sense. And of course, management blamed the macro environment for this.
Of course. The CEO, Rostov, he framed it as good execution in a tough wait-and-see economy. He is citing interest rates and trade tariffs as the big culprits.
So the story is that clients just got nervous. They didn't cancel deals. They just pushed the big ones off. The needle movers, as they call them.
That's the narrative. They saw a clear shift to smaller auction lots, non-essential stuff. Dove had this great analogy. He said it was like being a journeyman fighter going all 12 rounds.
Oh, I love that.
Yeah. It means they were busy, throwing a ton of small punches, making a little profit just by being active, but they couldn't land that one big knockout blow. It just sounds exhausting.
It sounds like a low-margin business is what it sounds like. So were any parts of the company holding up better than others?
There was a bright spot. The industrial assets division was actually pretty resilient. Its operating income went up from about $0.7 million to $0.9 million.
And why was that?
It looks like the strength there came from their refurbishment and resale segment. That's a higher margin activity, so it helped offset some of the weakness elsewhere. The financial asset side was still profitable, but it definitely softened.
Okay, so that brings us to the pivot. Management clearly knew this was a bad quarter to report, so they spent most of the call trying to get investors to look at the future instead.
This is where they try to get you to look at the windshield, not the rearview mirror. And their big bet is on the industrial side. They're almost done building out a new facility in San Diego.
Right, I saw that. It's for the high-margin refurbishment stuff you just mentioned.
Exactly. It's a structural investment. They're trying to build a business that's less exposed to the whims of the auction cycle.
But the real story, the thing they hammered home over and over, was M&A, mergers and acquisitions.
100%. They made it very clear they are done fine-tuning. They are now in tactical execution mode for buying other companies.
And they have a name for it, the GS plan.
Right, for geography and sector growth. They're looking for targets that can plug the gaps, things that will be accretive quickly. The message was loud and clear. We are about to do a deal.
Okay, but this raises a huge question for me. If they're so confident and the stock is down 23% on the year, why didn't they buy back any of their own stock? They have a $7.5 million buyback authorized.
And that is the central tension of the entire call. It's a massive credibility question, and they had to address it.
So what was the answer?
Their answer was explicit. We didn't buy back stock because we're saving every penny for an acquisition. They said they have advancing progress on the M&A front, and they don't want to risk the liquidity.
So they're telling you a deal is that close.
They're signaling extreme conviction that a deal is imminent. They think buying another company is a much better use of capital right now than propping up their own share price.
And do they have the firepower to actually do a meaningful deal? What's the balance sheet look like?
Oh, it's very healthy. They are ready to go shopping. They have $19.4 million in cash. Stockholders' equity is solid at around $66.5 million, and they've cleaned up their debt.
Right. They paid off that old ALT note.
Paid it off. The only real debt is a small interest-only mortgage on the new HQ, so they have very little leverage and a nice cash war chest ready to deploy.
And what about the outlook? Any guidance for Q4?
No formal guidance, but the tone was, let's call it cautiously optimistic. They talked about Q4 historically being their strongest quarter, especially for financial assets.
As banks clean up their books for year-end.
Exactly. They're hoping those big industrial deals that got pushed off will come back as the macro picture clears up. But, hope isn't a strategy. The market reacted to what happened, not what might happen.
Let's talk about that reaction. The stock action was just brutal.
It was severe. The stock dropped about 9.1% the next day. It went from $1.43 close down to $1.30. And this wasn't just a slow drift down.
No, the volume told the story.
The volume exploded. It was around 403,000 shares, which is 4 or 5 times the normal daily average. That's big money repositioning, basically saying, we don't like this margin story.
And you have to put it in the context of the whole sector, which makes it look even worse.
Absolutely. The stock is down over 23% in the last year. Meanwhile, the capital markets industry ETF, the IAI, is up 39% over that same period.
That's a massive divergence. So this isn't a market problem, it's an HGBL problem.
It's a company-specific problem. They are being punished for their own execution issues.
Okay, but here's where the story just splits in two, creating this huge valuation disconnect. You have the market hammering the stock down 9%, and then you have the Wall Street analysts.
It's like they're living in two different realities.
Yeah.
The company has 4 buy ratings from analysts, and their average price target is somewhere between $3.50 and $4.
Wait, from $1.30 stock price?
Yes. Do the math. That's an implied upside of 160% to 190%. It's just a massive gap. The traders are focused on the Q3 miss, and the analysts are focused entirely on that M&A story and the balance sheet.
So what could actually bridge that gap? What are the catalysts that get the stock from $1.30 to, say, $3.50?
There are really only 3. First and foremost, they have to announce a deal, a real M&A deal that the market agrees is a good one.
That's number one with a bullet.
Second, that new San Diego facility needs to come online and start contributing high-margin revenue. And third, they need to execute on some of the big bankruptcy auctions they've won, like the Castle assets. They need to land one of those needle movers.
But the risk is still there. I mean, even the bulls seem to be getting a little nervous.
That's right. After the call, we saw analysts actually cut their full year 2025 estimates. EPS estimates came down by 17%. So even the guys with the $4 price targets are saying, okay, the near term is going to be rough.
It's a classic jam, waiting for the strategy to actually become reality.
Exactly.
Which brings us to our favorite segment. This is not financial advice. We have this perfect setup. A company with a beaten down stock, but a strong balance sheet, and a management team screaming that they're about to do a deal. What's the trade?
Okay, so the trade here is all about that tension. The market is pricing this like a broken company. Management is pitching it like it's a coiled spring. The setup is a microcap with tons of cash that has explicitly told you why it isn't buying back its cheap stock to save the cash for a bigger prize.
So you're betting on management's credibility, basically.
You're betting on their credibility and their imminent action. The trade I'm pitching is to go long HGBL common stock, but you pair it with another move to juice the return and define your risk.
Okay.
You sell out-of-the-money puts. For example, you could sell puts that expire in 6 months with a strike price of, say, $1.
Ah, I see. So you collect a premium from selling the puts now, which lowers your cost basis on the stock.
Precisely. And you're basically using the company's own cash cushion as your safety net.
Explain that. How does that work?
Well, think about the two scenarios. If they announce an accretive deal, the stock probably gaps up toward those analyst targets, and you make money on the stock. The puts expire worthless. Win-win.
And if they don't, and the stock keeps falling,
If the stock keeps sliding down toward that $1 strike price, what does the company have? They have $19.4 million in cash and a $7.5 million buyback program that they can flip the switch on at any moment. You're betting that they would step in and support the stock before it falls much further. You're using their war chest as an implied floor for your trade.
so it's a bet on capital deployment one way or another, either through M&A, which sends the stock up, or through buybacks, which puts a floor under it.
That's the trade. You're betting that cash is going to be put to work, period.
So let's wrap this up. We have a really disappointing quarter, no doubt about it. A wait-and-see economy that's crushing their margins. But that's countered by a management team making a hard pivot to M&A, backed by a really strong balance sheet. It feels like an inflection point.
It really is. The market is punishing the short-term results, while the analysts and management are focused on this consolidation story. It's left the stock at what looks like a ridiculously low valuation relative to that optionality.
So here's the final thought we'll leave you with. Is Heritage Global a fundamentally undervalued company, a consolidator that's just one press release away from unlocking 160% of upside? Or is management just waiting too long, risking more bad quarters and forcing those bullish analysts to finally throw in the towel? It's a race between strategy and execution, and you have to decide which one gets to the finish line first.